You're both saying we're in the new Great Depression or heading into the new Great Depression. So the question is, how do you reconcile your negative views with such a positive market behaviour at the moment? And I might ask Jim, would you like to answer that first for me?
A lot of people don't understand what a depression is. You know, a recession with the R, 2 or more consecutive quarters of declining GDP. So economists like it because it's quantitative. You can plug it into a closed form equation. They like that. Depression, the D word. Economists have banished the D word. They don't like to talk about it because they think they're too smart to ever have one. We're in one now. Japan's been in one since 1989. You can have growth in a depression. Depressions do not mean continuous declining growth. What they mean is occasional technical recessions and growth, but growth below trend. It's depressed growth. So if your trend is 3.2%, or your potential is 3.5%, and you're growing at 2.2%, which we were from 2009 to 2019, or I expect even less, maybe 1.9% in the coming years, that's depressed growth relative to trend. That's a depression. If 1%, the difference between say 3.2 and 2.2, if that doesn't sound like a lot, it is. You take 1%, put it on a $24 trillion economy and compound it over 10 years, you're looking at $300 to $400 trillion worth of, $3 to $4 trillion of lost wealth, lost output, money we could have had if we could have performed at trend. So you can have the depression, but you can still have inflation. There's a name for it. It's called stagflation. We had it in the late 1970s. In other words, I am projecting slow growth. I am projecting a depression. The effects of this pandemic will be intergenerational. They'll be with us for 30 years. But that doesn't mean that you can't have inflation. And by the way, I should just add, because I was looking at the questions myself. I can't answer all of them. There are too many, but I think it's great that there's been so much participation. But one of the questions that came out was, hey, Jim, in your new book, you talk about deflation, and yet you just spent 20 minutes explaining why we're going to have inflation. And they're both true. Very short term, meaning the 2021, the tendency is still towards deflation and disinflation. What's amazing about gold is that with deflationary headwinds, which we have had, gold has still gone up, almost doubled in the last 6 years, and it's held up very well. It gets knocked down every now and then, but if you had the kind of impact Harry's talking about, why isn't gold at $1,000 already, or even lower? So I'm impressed with the performance of gold in a deflationary environment, which we have had. But we're right at that inflection point. We're right at the point where it tips into inflation and accelerating inflation beginning in 2022 and thereafter. So the way to reconcile that, very short term, meaning a year or less, more disinflation, borderline deflation, but that's going to turn very quickly. So that's how I reconcile that. And by the way, just to be clear, I agree with Harry that we have come through enormous deflationary trends. I mean, that's absolutely correct for the reasons I mentioned, which were the cheap Chinese labor, hundreds of millions of people coming off the farm, going into Lego-style assembly, and other factors, and then all the money printing. The reason the money printing didn't produce inflation was because it was just holding its own against the deflationary trends, which were demographic and globalization and automation and a number of other factors. But the point is, and what I think is being missed in the discussion, is we're right at the inflection point. So if you ask me about Harry's thesis about deflation, I would say, yeah, that's been the story of the last 20 years. Absolutely right. But we're right at the point where that's going to flip. You can't just extrapolate deflation. You have to watch the turning points, the tipping points, and we're right at one right now.
Okay, I am crystal clear about what depressions mean typically. Depressions, almost the thing they always involve, unlike the 1970s, and unlike what we've even seen in Japan with kind of zero inflation or deflation, it's the deleveraging of debt and financial asset bubbles. That's when you see a depression rather than a deep depression. Demographics predict deflation or inflation because slowing workforce growth is deflationary, and rising rapidly, like in the 70s, is inflationary. So in the 70s was due to be an inflationary thing, and people now still think the governments printed money in the 70s. They didn't. They ran deficits in a recessionary, inflationary economy, but they were not printing money off the charts like they are now. They did print money in 1932 at the end of the first crash, because it was so bad, but they printed it like 6% of GDP rather than now. Real quickly, when you print all this money and do all these assets, why do I not listen to the markets? The markets are on crack, okay? Would you listen to a crack addict and ask them, of crack addicts on a roof, what are they going to do? They're going to try to fly off of it. The markets have been fed free money. All this money comes in, adds to the financial asset pool. It's not been given to businesses and consumers until just recently with fiscal stimulus. It pumps up financial assets. They're on crack. They're going up. They don't need a good reason. Oh, but they have earnings, and the price earnings is not that high. There wouldn't be any earnings because there wouldn't be any economy. We'd be like Japan or worse if it weren't for this constant money printing. Everything is fake and artificial, and the markets are so high they don't know it. And they don't want to listen to me or Jim because everybody out there, from Warren Buffett included, everyday people, financial analysts, Wall Street, everybody's high. Nobody high wants to be told they're high, and they're heading towards detox. Debt deleveraging, financial asset bubbles is detox. It sucks. That's why nobody would choose it. Central banks will not choose it. They're going to blow this thing until they have the avalanche, and then deflation will take over. The economy will heal itself so fast. Income inequality will be solved so fast. Debts will be leveraged like they did in the early 30s. 62% of private debt disappeared. That's good. That's a detox. That makes you healthier, even though it almost kills you. So that's the way I see depressions. That's what's unique. And depressions have deflation. Japan's only thing, they had the financial assets deflated first. They never let the debt deflate. That's why they're in between inflation and deflation, and they're going to end up in deflation. And guess where Japan's demographics go? Down again as strong as they did in the 90s. So Japan is going to deflate this time because they're going to go down so hard they'll have no choice. Our markets are going to cause this crisis, and then debt gets restructured because the markets collapse, and the economy cannot grow without these markets feeding the rich, who are the only people still spending money out there. So if you're selling yachts, sell them now because they're not going to be selling very soon. The rich are going to lose the most money when this bubble bursts, not the poor. Do you think Jerome Powell or Janet Yellen, putty cap, okay? You think they're fast enough on the draw to print that much money ahead of time fast enough? You think they're gunslingers? You think they got the to do that? And do you think people will let them? If after we just printed more money in 1 year and more fiscal stimulus than the whole past cycle, and we still fall into recession again, and that's the key. We have to fall, the economy has to weaken, or the markets have to weaken to trigger this. But if that happens again, do you think people are going to say, well, why don't we do the same thing we did before? Duh.